Good morning and welcome to this webinar about the role of accountants in climate-related reporting. Today we are joined by Karen McWilliams from the Chartered Accountants Australia and New Zealand to discuss the recent updates in climate disclosure and how the role of accountancy profession has and could respond to the growing demand for decision-useful climate-related information. We will also introduce you to the new online courses on climate-related financial disclosures as part of the TCF Dean Knowledge Hub. My name is Gemma Clement and I am Project Manager at Climate Disclosure Standards Board. My role focuses on supporting companies with their disclosures, including in implementing the recommendations of the Task Force on Climate-Related Financial Disclosure. In particular, I manage the TCFD Knowledge Hub and our Beyond Disclosure programme. I'm also delighted to welcome Karen to share her thoughts today. Karen is the Business Reform Leader in the Advocacy and Professional Standings team at Chartered Accountants Australia and New Zealand. She is responsible for shaping and influencing business reform issues of relevance to Chartered Accountants, including insolvency, corporate governance, anti-money laundering, corporations law, and sustainability matters. With over 20 years' experience in a variety of business and advisory roles, she started her career in the specialist field of audit and has held positions with Worley Parsons, Ernst & Young, and Deloitte in London. She is a fellow Chartered Accountant with the Institute of Chartered Accountants in England and Wales, a member of Chartered Accountants Australia and New Zealand, and holds a Master of Arts in Mathematical Science from the University of Oxford. So we are in very good hands for this webinar today. Now, before we get started with the webinar, I just want to go through a few housekeeping points. The slides and the recording will be circulated shortly after this webinar. And if you have any questions, please use the Q&A section in the right-hand menu. We do have time at the end to answer some of your questions, so make sure you get them in. If you ask a question and we don't have time, then we will get back to you separately in an email. So for those of you who don't know very much about CDSB or need a little bit of a refresher, the Climate Disclosure Standards Board is a consortium of 9 business and environmental NGOs. And you can see our board members there on the screen in front of you. We also have a technical working group of over 40 experts who help drive our technical content. We were set up at the World Economic Forum in 2007 with a mission to create the enabling conditions for material climate change and natural capital information so that it can be integrated into the mainstream annual report. We achieve our mission by offering a framework for reporting environmental and climate change information. And this is our framework here. So the CDSB framework was developed in line with international accounting standards using a lot of the same terminology. It includes 7 guiding principles for effective disclosure and 12 reporting requirements. We updated our framework in 2018. It's fully aligned with the TCFD recommendation and is complementary to a number of other reporting standards and frameworks, as well as existing regulations. Now, I'm sure many of you have heard of the TCFD, but again, as a bit of a refresher, the Task Force on Climate-Related Financial Stability, the Task Force on Climate-Related Financial Disclosure was set up by the G20 Financial Stability Board in 2015, and their final recommendations were published in 2017. And their mission, which was very similar to CDSB's mission, was to look at how to deliver consistent and comparable decision-useful climate-related financial information to investors. So the TCFD recommendations are a voluntary set of recommendations that focus on financial disclosures in annual financial filings, or the mainstream report. They focus their recommendations on financial sector, including banks, insurance companies, asset managers and asset owners, but they also look at high-risk non-financial sectors, for example, energy, agriculture, materials and building, and transport. Now, the TCFD recommendations focus very much around the idea of climate-related risks and opportunities. And climate-related risks can be broken down into transition risk and physical risk, as they clearly define in their recommendations. What's specifically new about the TCFD recommendations is that they've added additional information about scenario analysis. So that's looking into the future and understanding how businesses may be affected by climate and climate change. Now, what you can see on your screen are the core elements of the TCFD recommendations. So they provide 4 core elements: that's governance, strategy, risk management, metrics and targets. And within those core elements, there are 11 recommended disclosures. The core elements are featured here in concentric circles because they're all interlinked and should inform one another. So they shouldn't be seen as separate reporting recommendations, but as a suite of information that gives investors a broader understanding of how businesses may be affected by climate change. So the TCFD recommendations came out in 2017, and there's been a lot of things happening since then. So I'm going to pass over to Karen now, who's going to give you a brief update on what's been going on in Australia and New Zealand.
Thanks, Gemma, and thank you for having me on this webinar, and also appreciate that you holding this webinar at a time that is a little bit more sociable for Australia and New Zealand, since we usually get the dead of night ones, but I think in compromise it means you're up very late tonight doing this, so we much appreciate you taking the time. So in terms of what's happening in Australia, if you'd like to jump to the next slide, please. So as Gemma indicated, there's been, since the TCFD came out in June 2017, there's been quite a lot of activity, and particularly in the Australian and New Zealand market. So looking at what's happening in Australia, ASIC last year, so in June last year, said that they were going to actually look at the climate disclosures of companies in the Australian marketplace, and they did, and they produced a report in September of last year that actually said this is what they'd seen. So we expect that they will probably be doing the same for this year, but we've yet to see a report out. So looking at their recommendations from last year's report, they really advised and I guess encouraged listed companies and their directors and advisors to adopt a proactive approach to emerging risks, which they see as including climate risk. They encourage them to develop and maintain strong and effective corporate governance to help in identifying, assessing and managing that risk. They also said that they needed to consider how best to comply with the law where it requires a disclosure of material risks, and also to disclose meaningful and useful climate-related information to investors. And they noted that the TCFD that Gemma's just discussed can be used in that regard, although it is a voluntary framework. Subsequently, and then sort of earlier this year, in August, ASIC actually then has updated its guidance to the operating and financial review that organisations need to produce, IG 247, and also prospectuses. And they've updated them to incorporate that they see climate change risk as one of those, an example of a common risk that needs to be disclosed in the prospectus RG 228, and also that climate change is a systemic risk that can impact financial prospects for future years, and they see that as needing to be disclosed or may need to be disclosed depending on the entity in the OFR. They also have updated one of their information guides on impairment of non-financial assets to also include reference to climate risk. Additionally, the corporate governance principles, the 4th edition was released in February of this year and will be effective from January 2020. And in particular, amongst other updates, recommendation 7.4, which deals with risk, actually is now being enhanced to specifically refer to climate-related risk and make reference to the TCFD. So there's been quite a lot of activity. In addition to ASIC, I mean, ASIC's comments have been very much around non-financial risks can have financial consequences, or more to the point, all risks can have financial consequences, so there's a need to take account of them. Other regulators, APRA and the RBA, have also been quite vocal in encouraging the need to disclose climate-related risks. If you want to jump to the next slide, please, Gemma. Thanks. So what's happening in New Zealand? The big area of focus, I guess, when we're looking specifically around climate risk is in relation to the government's response to last year's Productivity Commission report on the low emissions economy. Now, their response was released in early August of this year. And the Productivity Commission made two recommendations. The first one was for the government to endorse the recommendations of the TCFD. And the government has said that, yes, they endorse the TCFD as an avenue for disclosure of climate risk. So that was fairly positive. The second recommendation was around the government implementing mandatory principles-based climate-related financial disclosures. And that those disclosures should be audited and accessible to the public. Now, the government has said that they agree with that, with the need to, have greater disclosure. And what they're going to do is give further consideration around where those disclosures should sit and in which piece of legislation, the type of entities that will need to disclose, and whether that should be there. I guess at the moment they're considering listed insurers, registered banks and listed issuers, registered banks and licensed insurers should be covered. It's not clear at the moment whether they should include any other classes of entities, and they've indicated they will probably go out to consultation around that. And also they're going to give consideration to what specifically the disclosure requirement should be. Should it be TCFD? Should it be some sort of subset of that, or exactly what we don't quite know. So that will be expected, I guess, through consultation later this year, and hopefully we'll start to see where that might shape in that regard. Jumping to the next one, please.
Thank you, Karen. So Karen's just given us a really great overview of some of the more specific things that are happening in Australia and New Zealand, and it sounds like there's a lot of things happening and potentially a lot of things happening very quickly. Earlier this year, the TCFD released their second status report. So that was released in June of this year, and it looked at how reporting in general has improved over the last 3 years and the status of reporting. So at the time of the release of this paper, they had just over 820 supporters, and since then it's grown a little bit more, with a market capitalization of over $9.3 trillion. So 65 of these were Australian, and 2 of these were New Zealand-based organisations. Now, underneath that number, you can see there the implementation guide that was provided by the TCFD in their final report in 2007. We're now into our 3rd year of TCFD reporting. So what we should be looking at is that organisations are beginning to disclose information in their financial filings, and perhaps in some cases climate-related issues should be now being seen as a more mainstream business and investment consideration. However, we're not quite seeing very many organisations quite getting up to that standard just yet. We're still seeing a lot of companies towards the bottom of this curve, where they are looking at what they're already disclosing and working towards disclosing this information in their mainstream filings. Going into a little bit more detail about what the status report said, their findings from 2 analyses. So one was a survey of users, and the other was a in-depth review of over 1,000 annual reports globally. And what they found was that despite the support of the TCFD rising quite significantly, companies are still finding it challenging to implement the recommendations, resulting in insufficient disclosure for investors. More clarity is needed on the potential financial impact of climate-related issues, and the majority of companies do not disclose information on resilience. Also, mainstreaming this information, so putting this information in the mainstream report, remains challenging and will require the involvement of multiple functions within an organisation. Now, I think a lot of these challenges should speak to the accountancy profession. A lot of these things, accountants have the existing experiences and skill sets to be able to help plug these gaps. So if we move on now, and we can look at what is the role of the accountancy profession and how can they help with climate-related disclosure. I'm going to pass over to you, Karen.
Yes, sorry, thank you. I was just trying to find my mute button. So the accountancy has always been a case of responding to new market opportunities, the changing demands and expectations, and new legal requirements. And I guess climate change now just fits into one of those areas. It's now increasingly being demanded in terms of disclosure from investors, and expectations are that companies should provide those disclosures. And when you start looking at the role of accountants, it seems to be a bit of a natural fit. And certainly, as Jem has indicated, with some of the areas coming out of the TCFD report around disclosure and the clarity on financial impact, it seems like an obvious space for the accountancy profession to be playing in. Would you like to jump to the next slide, please? So just thinking about why this fits into, I guess, the domain of professional accountants. As I mentioned earlier, all risk now is known to have or can have financial consequences depending on the organisation. And the impact of climate-related risks and opportunities falls into one of those spaces. Whether these risks are financial or non-financial, they can have the financial consequences if they're material. As noted around where the TCFD disclosure should be, they should be within the financial filings, which is typically the domain of professional accountants as both preparers and auditors. The drive for reporting is coming from investors who are wanting robust, reliable and comparable information for decision making. And this is the kind of information that they've had from the financial statements in the past. And we're also seeing the financial regulators and standard setters engaging in this space and actually saying that this is something that they expect to see coming through in the disclosures to the marketplace. So again, it's something where we see the profession playing a critical role. We've also got the need for cross-functional teams to deal with this and actually managing different aspects of the disclosure. It's not just going to be the professional accountants, but we are going to need engineers and risk experts and other types of experts to bring their skill sets into it, and the need for collaboration. Materiality is going to be critical, and working out materiality for these different areas is becoming quite tricky, and I guess accountants, already have some skills around determining materiality. And I guess finally, the whole thing is about building transparency and trust within climate-related reporting. And professional accountants, through their code of ethics, act within the public interest. If you'd like to jump to the next one, please. So if we look at, I guess, again, the skill set of accountants and where this is relevant, whether you're in practice, in business, in tax, audit or consulting, in our opinion, professional accountants do have the necessary skill sets to contribute towards this growing demand for climate-related disclosures. Obviously, risk management is key. It's one of those sort of bubbles for the TCFD and one of those key pillars. So when we look beyond the typical financial risks and how the external environment impacts on the organisation, such as climate change, we've got to think about, well, how do we identify those risks? How do we assess and how do we manage them where possible? There's a need to understand the business and actually understand how the climate risks, whether they be critical or transitional, will impact the organisation. There's a need to analyse the data to provide the strategic insights and advice This has already been done for the financial information, so it's just an extension for the application for non-financial. And a lot of accountants are probably already doing this. It just may not be in relation to climate-related risks. We need to provide the decision useful information that investors are going to need for their decision making. We're going to need robust internal controls throughout the reporting process to ensure that the data can be relied upon. Scenario analysis, which is obviously forms part of the TCFD, will have quite a high degree of assumptions and judgment, and I guess assessing the reasonableness of them and the estimates that are used, where accountants are already applying professional judgment in other estimates and assumptions, for example impairment calculations, and we'll start to see a connection between the two around that in terms of actually considering climate change as part of those impairment assessments. As I mentioned, the use of experts, so actually having these multidisciplinary teams and how to actually manage them and use the work of experts to bring through to the decision-making process. We're going to need evidence-backed disclosures, so ensuring that disclosures actually have appropriate evidence to support them and actually be able to evaluate the quality of those disclosures. And obviously accountants also are used to keeping up to date with the current reporting and regulatory standards and requirements, and that's something that's going to be ongoing and it can easily be applied now into this sort of climate disclosure space. If you'd like to just pass on to the next one, please. And I guess another reason why it's incredibly relevant to professional accountants is we've seen the Australian Accounting Standards Board and the Audit and Assurance Standards Board release a practice statement in relation to climate-related and other emerging risk disclosures. And in this, they're looking at the application of materiality to whether or not climate-related risk disclosures and other emerging risks, so it's not just climate related, but I guess the reason why there's a focus on that is because that's where we've seen very strong demand from investors for that information. But they're looking at whether or not those sorts of disclosures actually have a space and need to be within the audited financial statements, so within that core part that is very clearly the domain of the professional accountant. And so what they've suggested here, as this flowchart kind of indicates, is when determining how you might apply materiality in the context of these emerging risks such as climate change, then we need to consider whether investors could actually reasonably expect there to be an impact on the entity and whether that would actually influence their decisions. Now, if the answer to that is yes, then I guess the next thing is to determine, well, how much will it affect the amounts within the financial statements? But actually, when you go down to the boxes below in determining what you should do, obviously, if there is an impact in the financials, it needs to be disclosed. But if the determination is that there's not going to be an impact, there's still a need to actually disclose the assumptions that have been made. So I guess investors have an expectation that it will impact the organisation. And so they've indicated that from a materiality perspective, there's a need to actually explain to them that no, it won't have an impact for these assumptions. Now, this is not suggesting, and the AASB is certainly not suggesting, that we should see disclosures of the full TCFD within the financial statements. But what they are saying is, I guess, the application of when something's material risk and when it should be within the financial statements is certainly something that's now should be applied to climate-related risks and others. And let's not forget that it does also, I guess, apply from an auditing and assurance standards board perspective. And they've indicated that auditors of the financial statements will probably want to consider climate-related risk and other emerging risks as part of their risk assessment when applying ASA 315 in identifying and assessing risks of material misstatement. So understanding whether they think there's going to be risk of material misstatement, and obviously then they're going to need to respond to that. And also whether climate-related risks and other emerging risks are relevant for accounting estimates, such as assumptions when they're arriving at fair values and potential impairments, as I indicated earlier. So I think when we look at that perspective, we can see very much why accountants are going to need to engage with this. Would you like to just jump to the next slide, please? So where do we go from here? As indicated, certainly part of what we're doing through both the work of chartered accountants, and obviously we've been engaging with CDSB for quite some time now on these topics, and other organisations, is really trying to use this and use webinars like this as an opportunity to raise awareness with accountants and with our membership that this is something that isn't just to be ring-fenced off to the side for the sustainability team, but actually it is something that the finance function and financial auditors need to engage with. It's risks that are now impacting the organisation. We've seen financial regulators, we've seen standard setters very strongly engage in this. Investors are saying it's decision useful information. I mean, it's really important that accountants actually start to take this on board and look at it from a perspective of the organisations they work for and with. And to do that, obviously the opportunity then is to make sure that accountants have the knowledge that they need to do this. Now, there are a number of resources available, both through chartered accountants and through the TCFD Knowledge Hub that Gemma's mentioned. And I'm going to hand back over to Gemma now because she's going to talk through some of the training that's just come out, which also includes some specific training for accountants.
Thank you, Karen. Yes, so as Karen just mentioned, earlier this year, in fact, just over a month ago, CDSB released some online courses as part of the TCFD Knowledge Hub. And we thank Karen and other members for their input into these courses to make sure that they are relevant and detailed for accountants and for anyone else interested in learning about climate-related information. So I'm not going to talk over this slide too much because I think that we've already covered what the aims of the course are, because it's around making sure that people understand what the TCFD is and to understand what climate-related financial disclosure broadly is, because we're seeing at the moment that there just isn't enough disclosure, and the disclosure that is coming out isn't at the standard that we need it to be. In the status report, Michael Bloomberg, who is the chair of the TCFD, says that progress needs to be accelerated. So these online courses are designed to kind of help plug that knowledge gap and to make sure that people understand the different elements of climate disclosure. We also want to make sure that we describe the landscape of reporting, because again, as Karen mentioned before, there are a lot of resources out there. There are some that are very specific for climate-related disclosures. There's some more broadly around sustainability reporting. There are some that are specific for accountants, and there are some specific for sustainability professionals. So these courses help also to map out the broader landscape of reporting and to create a business case for why climate-related financial disclosure is important. So the specific courses are have specific topics and cover audiences, specific audiences. The wrong way. There you go. So these courses are hosted on the TCFD Knowledge Hub. The TCFD Knowledge Hub was developed by CDSB and was launched in 2018. And the Knowledge Hub is a central place where you can find all of the information that you might need to help you understand climate-related financial disclosure and also to help you on your journey to disclosing this information. So you can go into the resources section where there is a database of over 400 resources. If you have any resources that you know of that you found particularly helpful, you can contribute. We also have some case studies from companies who have either adopted the TCFD principles and recommendations or are in the process of adopting them, and they give us some idea about how they've gone about implementing those recommendations. And there's also some information specifically around scenario analysis, because we know that that is an area that a lot of people find particularly challenging. So these online courses are self-paced, so you can do them at the pace that you want to do them. You can also walk away if you don't have time to finish them in one go and come back, and it will bookmark the course so that you can pick up where you left off. And the lessons include activities and quizzes, various things to kind of get you engaged in the topics, including video interviews with a number of experts. There is, and I know this word is dreaded by lots of people, but there is an exam at the end of each of the courses, and once you finish that exam, you can then get a CPD accredited certificate that you can hang up on your wall and be very proud of. And we also have a forum for discussion, and we're already seeing some people asking some very challenging questions about some of the technical complexities of disclosing such information. So course 1 is designed for everybody and anybody, and it's basically giving a 101 of what climate-related disclosure is. So looking at the evolution of corporate reporting, including financial corporate reporting, and how it's got to the stage that it has now, and why climate disclosure is important. It provides some of the key concepts of climate disclosure. We don't cover everything because otherwise you'd be there for a very long time, but we pick out some of the key elements like materiality and forward-looking information, and we dig a little bit deeper into what that means. And as I mentioned before, we also introduce the corporate reporting landscape, looking at some of the key players involved, some of the regulations, standards and frameworks that are widely used and important in the development of climate disclosure. Course 2 looks very specifically at the TCFD, and again, this course is designed for anybody who is interested in learning more about the TCFD. It's kind of a 101 of TCFD. So we look at the 4 core elements, and that's governance, strategy, risk management, metrics and targets, and we dig into those in a bit more detail to explain what they are, ask some questions, and provide some examples of companies who have attempted to disclose against these elements. But I think most importantly for this webinar today is that course 3 is very specifically designed for accountants, and we look at a lot of the elements that Karen has talked about earlier in this webinar, and we pull out what exactly is the role of accountants, and what are the existing practices and skill set that accountants have that can be adapted when looking at disclosing climate-related information. Not just disclosing, but also how this data is collected, identified, measured, and managed, all things that speak to the accountancy profession. So these courses were developed with insights from a variety of experts from around the world, and I'd like to take this opportunity as well to say thank you to all of these people. Some of these people provided videos, some of these organisations provided content for the lessons so that we know that all of the information is relevant, up to date, and from people who know what they're talking about. Now, I was going to do a very quick demonstration of the hub, but just in case technology fails me, which it usually does, I've just taken a few screenshots just to kind of give you an idea of what the site looks like. So you can, once you've logged on, you can choose any of the courses that you want to do, and you can access them. Once you've enrolled, you can access them at any point. And once you've completed various tasks and activities, you can earn yourself a badge of success. You can go through the learning objectives and outcomes and get a better understanding of what you'll be able to learn from these courses. And you can also keep track of completed tasks. That's automated, so as soon as you finish something, it'll automatically tick it off so you know that you're done. Once you go into the lessons, you can work your way through, clicking on the different topics. Each section is relatively short, and as I said before, you can go away and come back and it'll bookmark where you've left off. This is an example of one of the videos that we have on there. I know that it says that the video is 12 minutes long. It's probably the longest video that we have in there. Most of the videos are relatively short. This particular video is looking at the investor perspective. So that's why it's quite a long video. But you can hear from those people in the field talking about their experiences and giving you tips about how to move forward. And I know that everyone will dread this, but the exam at the end is relatively straightforward. You can attempt to call the exam as many times as you like, and there is also an opportunity for you to go back and review some of the content, so that if you get the questions wrong, you can go back and have a look and reflect on what the answers might be. So in terms of what's next, especially for the online courses, those are just the first 3 that we have developed. We are now developing a few more, so the next ones that will come out will be centered around corporate governance and climate-related governance in particular. We're also looking at developing courses specifically on risk management, and also broadening the horizon from climate change and looking at how water and biodiversity and other elements of natural capital fit within this landscape. So do go on to the website, which is learn.tcfdhub.org, register and enroll in any of the courses and get involved in some of the discussions. Now that brings us to the end of this part of the webinar. We have some time for a few questions. I see that there are a few coming in. If you do have a question, make sure you pop it into the Q&A function. And as I said at the beginning, if I don't quite get to your question, we'll make sure that we reach out to you afterwards and provide you with an answer. So Karen, there's a question that's come in, and I think this one speaks mostly to you. Will accountancy standards and potentially IFRS rules be changed or updated, or will there be new ones to reflect climate-related disclosure?
Thanks, Gemma. Look, it's an interesting one. Our expectation at the moment is that we won't see new standards coming out, that the existing standards adequately deal with what is needed here in a way that we've seen with the AASB and AUASB's guidance on materiality. It's more around application of those existing standards, and so providing clearer guidance on how they may apply in these, emerging areas. We know, obviously, we've got the AASB guidance. The International Accounting Standards Board are looking at their management commentary and reviewing that, and it's expected that that will, have a broader view, but that's not a standard. That is only a guidance practice statement anyway. And then additionally, at the moment, the International Auditing Standards Board are also looking at providing additional guidance on how auditors should deal with extended external reporting, which would encompass things like TCFD as well as integrated reporting and so forth. And so looking at producing some existing guidance on how auditing standards would apply in those situations. So my expectation is no new standards, but more guidance to actually how that they should be applied in these situations.
Fantastic. And CDSB has also done a little bit of work in looking at this, and we have the Uncharted Waters paper that was released a few years ago now, looking at how, just as you said, some of the existing standards can be applied as opposed to needing new standards. There's another question that's come in, and I think, again, this one speaks more to you, Karen. So what is the difference between climate reporting and climate-related financial reporting?
Thanks. Now, in this situation, I guess what we're looking at, the difference of when we're looking at, the climate-related risk disclosures and the disclosures around that, we're looking at the impact of the external environment and how climate change as an external risk will impact on the organisation, and particularly where it can have material and financial consequences to the organisation. So that might be, as we've mentioned, with the physical risks of climate change, or with the transitional risks as the world transitions to a zero carbon economy. And that's where I guess we're typically in the space of providing information to investors to inform their decision making. It's risks that are happening to the company, and so they do need to actually address them. It's not something that can be considered optional if they're going to have a material impact. When we then look at, well, emissions reporting, which is often where the two get confused, emissions reporting is where we're looking at the impact of the company on the environment. And obviously in Australia, large companies have a mandatory in terms of reporting their impact on the environment from an emissions reporting perspective. But there the audience is typically a bit different. And we're looking, I guess, and sometimes these things can, if you're not under the NGOs regime, it's also something that could be considered potentially optional. Although I know that there is a very strong argument for why it's necessary. And clearly, if the transitional risk on your company is growing, in terms of, and therefore the impact of your emissions, and there could be a cost in the future, then clearly the two are interlinked, but they are also different in terms of the reason why we're driving them. So I think, whilst I think the impact of the company on the environment can have an impact on the financial risk, there is a separation there as well. I'm not sure if that necessarily explains it very well, but
I think that explained it very well. We've got a few more questions, we've got a few more minutes, so I think we can squeeze a couple more in. There's a question specifically about the courses that have come in, and I can answer that. So the question is, are the courses free, and how long do they take to complete? So yes, the courses are completely free. So you can sign up. All you need to do is just add in your name and email address to make sure that you're receiving the completion certificates and all of the updates. And the courses, how long do they take? Well, it will depend on how long you have. If you were to sit down and complete the courses in one go, we estimate it will take between an hour and an hour and a half to complete, including the exam. But you do have the opportunity to complete it in small chunks, so that it's a bit more manageable in terms of how long it takes. I've got a really interesting question here, Karen, and I think either you or I can answer it. So the question is, how do we deal with materiality in relation to financial statements when the timelines for risk become more important in the future? So the example is, information may not be material to past year reporting, but could be in the future.
Yeah, thank you. So this is, I guess, it's a challenge that organisations are grappling with, is how do they deal with these things that are happening into the future, and also, I guess, the degree of uncertainty as well, as we've got timelines that go into the future, that there's a great degree of uncertainty around these impacts. In terms of the financial perspective, and if we go to perhaps where AASB guidance was around what should actually go into the financial statement, typically auditors, I guess, are looking at from a statement in terms of, is the business going to be viable for 12 months? Typically, we're not going to see massive amounts of impact there. But what we are likely to see is where organisations are assessing the fair values and doing their impairment testing, they're often looking quite some years ahead in terms of how long their asset life is. So if those asset lives are shrinking, then we will start to see potentially some impacts coming back through in the next few years, depending on the nature of the lives. They may just reassess the useful lives and so forth, but we may start to see some impacts, I think, in that space. The likelihood and the bigger areas really will be around outside of the financial statements, and where we're actually organisations are describing, I guess, their strategy and their business model going forward. So these are not areas that are necessarily subject to audit, but these are the areas where I guess we'd see in the operating and financial review, where you're describing the risks and opportunities for your organisation in the future. And clearly, depending on the nature of the business and depending on where those risks lie, it's, some organisations will see climate change feature, and they will need to consider them as part of both their risks, but also potentially the opportunities for them in the future as well. So I think there will be a difference, but clearly the timelines are tricky, and because the timelines are in the future, there's also a great degree of uncertainty, which does make things more tricky. But just because things are not easy doesn't mean we shouldn't be doing them. And I think that's where the challenges lie on some of these.
I think that is a perfect thing to end on. Thank you so much, Karen, for all of your insights. I think we could talk about a lot of these things for a lot longer, and perhaps we can find another time to go into a bit more detail about some of the trickier elements. Thank you to all the people who joined this morning. We hope that you found the information helpful, and it gives you an idea about where to begin if you haven't done, or how you can improve your practices. Do visit the TCFD Knowledge Hub and sign up to the e-learning courses, and do reach out if you have any additional questions. We'll be circulating the recording to this webinar later this week, but thank you all for joining, and goodbye.